TD Cowen has named Rogers as one of its top picks. Let's get more from Vince Valentini, Managing Director of Equity Research at TD Cowen. Vince, thanks very much indeed for joining us.
Great to be here, Andrew.
Give us the one or two factors on Rogers that make you think this stock offers upside.
Absolutely. So in the past 2 years, the telecom sector has been pretty weak, as most people know, a bit of a price war going on in Canada and some balance sheet struggles for a lot of the names. That's led most people to want to play defense. So what we've seen year to date is Quebecor and TELUS have significantly outperformed BC and Rogers because they were just viewed as a bit safer. We're making a call that we're going to pivot to more offense and shift Rogers to top pick because we think the industry is starting to show some signs of turning around. Both the industry itself in terms of wireless, we're seeing some green shoots of a bit more discipline on pricing and some good math on a large percentage of wireless customers in Canada have already repriced lower. Our math suggests it's about 60 to 65% of Canadian consumers. So a lot of the pain is almost done. And Rogers is well positioned if wireless starts to turn a corner. It's a very wireless heavy name. It's also got the lowest valuation in the group. So we think it's got the most upside if people turn their attention more to offense versus defense. And last but not least, Rogers has significant catalysts to improve their balance sheet, which has been a big overhang for the past year, ever since they announced they were buying BCE's stake in MLSE for $4.7 billion. People are struggling to figure out how their balance sheet can support that and how they're going to pay for it. That deal is finally set to close in early July. They just received $7 billion from Blackstone in an infrastructure funding deal, so they're rich with cash to be able to pay for that deal, and that's going to start the clock on them negotiating with other investors. So I think there's a very positive catalyst coming over, let's say, 3 to 6 months of them announcing a new group of investors who are going to join forces with them in the Blue Jays and MLSE to fix their balance sheet and surface value from that asset that they're arguably not getting any credit for. So those are two of the key reasons why Rogers is our top pick now, and we took our target up to $60.
That's interesting. So, just before I forget, of course, Rogers, an arch rival to our own parent company, BCE. And so they've got this huge sports franchise. And nothing is certain, I know, but you think that they may well announce a high-profile investment in their sports business that would give them cash to cut debt?
Yes. After the deal with BCE closes in 2 or 3 weeks, Rogers is going to own 75% of Maple Leaf Sports and Entertainment, which I think people now owns the Leafs and the Raptors and TFC. They've owned 100% of the Blue Jays for a long time. In total, those assets are worth somewhere between $12.5 to $15 billion. It's a very significant investment for Rogers. It's something they've signaled they do not need to keep all to themselves. So even though they needed to buy out BCE to get the ball rolling on restructuring the ownership of all these teams, the intention was always to bring in new private investors, which could be other wealthy families, it could be private equity funds. So that is what I'm saying to you is I think that deal has been not clear to investors because Rogers can't really talk about it until it's done. We're getting closer to that happening, and I think that would clarify for people A, what the teams are worth, and B, how they can get their balance sheet from, call it 4 times debt leverage down to 3.5, which is a comfort level for investors and for credit rating agencies.
Can you generalize, is this sports empire super profitable?
No, not particularly. Sports teams don't make a lot of money. There may be a couple of $100 million of EBITDA from MLSE and the Blue Jays combined on an annual basis, but that doesn't stop the fact that teams keep going for higher and higher values, and none of the teams we're seeing transacted recently, including the Los Angeles Lakers last week, set a new high water mark at $10 billion. There's no traditional cash flow multiples that support that, Andrew. It's sort of a scarcity premium and differentiated type of asset that wealthy families and private equity players seem to have a great hunger for. So we'll see if Rogers can deliver what they promised, but they certainly say there's a lot of people interested in partnering with them on owning these teams.
It always fascinates me that wealthy people love to own sports teams. I suppose it's like owning art. People spend $100 million on a picture. If you've got the dough, it's your choice what to do with it. The yield on Rogers, just over 5%. Is there a prospect of them increasing it, Vince?
Not in the near term, Andrew. Their balance sheet is still stretched, so they need to focus their attention on paying down debt. As we recall, they took on a lot of debt with the $26 billion acquisition of Shaw just over 2 years ago. So they still have another couple of years to pay that down. And if they end up with excess capital and their debt is fine, they'll probably look to buy back shares, given how low the valuation of their stock is right now, before they would look to increase the dividend. So you maybe 4 or 5 years out, we can look at that $2 dividend starting to go up again. But even if it just stays at $2 and it's well supported by cash flow at that level, there's no risk that they're going to cut it. You're right. It's because the share price has been so weak. It's now a dividend yield that rivals BCE and other names in the sector, where for a long time, Rogers' yield was much lower than the rest of the group.
The stock, like other telecom stocks, down sharply in the past few years, but I see Rogers has bounced off the bottom. Just tell us about that deal, because it's complicated, isn't it? Blackstone, they sold an interest in their business to Blackstone, $7 billion. What did Rogers give up with that deal?
They give up about $400 to $450 million a year in cash payments to Blackstone. So they're called minority interest payments. It's not technically lease payments or interest, because the Blackstone consortium owns a 49% equity interest in think of it as the fiber that connects all the cell sites across most of the country. So it's a backhaul network that carries all of the wireless data traffic. They had to kind of derive what that network generates, because forever that's just been part of Rogers. There was no transfer accounting and it wouldn't have been a separate network. So they had to separate it, figure out how much cash flow they're going to direct to that business, and then they could sell minority interest stake in it. So that's what Blackstone has bought, is that cash flow stream, and Rogers gets $7 billion in cash, which they can use to fund the MLSE deal and pay down other debt. They also get equity treatment for that from most of the credit rating agencies. So on paper, it helps lower their debt leverage by about 0.7. So they're going to go from 4.4, 4.3 approximately, where they were prior to that deal, down to 3.6. So they did it. It's a reasonably expensive piece of their capital structure, but worth it to them because it gets equity treatment from rating agencies.